Hello guys, I am Vicky Patil, stock trader and trainer at Money Mindsets. Welcome back to our channel. On this channel, we discuss information about the stock market and trading. In the previous video, we saw what is trading and some types of trading. In this video, we will discuss some terminologies that are generally used in the world of trading and stock market. So, if you haven't watched the previous videos, then please go and watch all the videos so that you get linked to this one. So, let's get started with the video without any delay. So, the first point in the video is what is BSE and what is NSE. Now, BSE is Bombay Stock Exchange and NSE is National Stock Exchange. These two are the markets where you can trade or the exchange of shares happens. In trading, we generally prefer NSE over BSE because NSE has more liquidity as compared to BSE. Now, liquidity is the number of exchange of shares that is happening in the market. Now, the next point, let's see what is Nifty. Now, Nifty is an index which is the average price of top 50 companies registered under NSE. Now, there are more than 1,500 companies that are registered under NSE, but only the top 50 are selected for the average price of Nifty. Nifty is also known as Nifty 50. Now, let's see what is Sensex. Sensex is an index of BSE which shows us the average price of top 30 companies registered under BSE. There are more than 5,000 companies registered in BSE, but only the top 30 are selected for the average price of Sensex. These two index show us the average strength of the market. Now let's consider these two index are moving up. We can say the overall stock market of India is moving up. And similarly, if both of these index are going down, we can say the overall stock market is going down. Now let's move on to the next point. The next point is IPO. IPO is initial public offering. IPO is a process by which a private company goes public company by selling their shares to the general public. After the completion of IPO, the company is registered under either of the stock exchanges. You can become one of the initial investors of a company by investing in their IPO. If the IPO is allotted to you, you become the owner of a small part of the company. We will come up with a video on IPO in the future. In that video, we will cover all the process and details about the IPO so that you will know whether to invest or not in a particular IPO. So let's move on to the next point. The next point is SEBI. SEBI is Securities Exchange Board of India, which is a regulatory authority for the stock market of India. For example, for all the banks in India, Reserve Bank of India is the central authority which regulates all the transactions conducted in the banking sector. Now, SEBI is just like the RBI for the stock market, which regulates all the transactions conducted in the stock market and protects the frauds or scams in the market. Now, let's move on to the next point. The next point is face value and market value. Now, the face value is the price of the share that is decided by the company at the time of the IPO, and market value is the current price of the share of the company that is in the market. Now, a face value can be 10 rupees and market value can be 10,000 rupees also. Market price is also known as LTP, that is last traded price of the stock. These were some of the basic terminologies used in stock market and trading. Now let's move on to some advanced concept in trading. Now let's see what is short selling. For that, we will get onto my iPad screen for detailed explanation. Let's see what is short selling. Short selling is a tool by which you can earn when the market is going down. So you can say that when the market moves up, we can buy and sell when the market goes up. Now, short selling is opposite of buying. In short selling, if you know or if you are thinking that the market will move down, you can sell the share first and then buy it back down and profit from that. Now let's take an example of a share that is trading at rupees 100 for now, and you think that it will move down to rupees 90. So in this case, you can sell the share at rupees 100. That means you will get 100 rupees by selling the shares in the market, right? Now after some time, when the market comes down to 90 rupees, you again go into the market with the 100 you have and buy the share at rupees 90. That is the current trading price of the share. Now you have 10 rupees left with you because you get 100 rupees from the market and you give 90 rupees in the market. So that 10 rupees that is left with you is your profit that you made. Now, how can you sell the share if you don't own it or don't have it? Now, you can borrow the share from your broker to sell in the market. Your broker will lend you a share to sell in the market, and when the price comes down, you buy back the share and give it to your broker from you have borrowed it. So I hope you enjoyed the video and gained knowledge about trading. Make sure to like the video, share your thoughts in comments and subscribe to the channel for more content. So that's it for today. We will see some more important concepts from the world of trading in the next video. So stay tuned for that.